See a vision of the future with laser-like technology in the all-new BMW 7 Series. The exception rules.
The warnings of an inflation shock appear to be borne out by January's CPI numbers out earlier. Headline inflation has jumped to 6.2% year-on-year, up 0.8% from December to January.
Higher inflation could also scupper a relatively resilient retail sector, also out with numbers today, which showed growth of 4.1% year-on-year in December, in what some analysts have described as exceptionally healthy, given what's happening in our mining and manufacturing sectors. Joining us now to make sense of it all is Thabi Leoka, economic strategist at Argon Asset Management. Thabi, thanks very much for coming to the studio.
It's a pleasure.
Thabi, I think we were all bracing for higher inflation this year. Did you expect it to filter through so soon?
No, I mean, economists had expected a 6% increase, or it increased to 6%, and we saw a 6.2%. And this is the highest, I think, in 18 months, we haven't had a breach of the upper limits of the target band. So it was very surprising that inflation actually increased to such an extent.
And one can only assume that you're bracing yourself for even more pressure to come, given the fact that food inflation has been amongst the biggest drivers here, and we've got, food price escalation showing no signs of abating just yet. And that with the rand weakness that continues and persists, and then the persisting drought conditions as well.
That's definitely, that's correct. So we are expecting an increase in the CPI in the coming months, and a few factors that you've mentioned. Firstly, it's food prices. We're starting to see pass-through. For the longest time, we've been wondering, when are we going to see pass-through from a weak exchange rate? We're suddenly seeing it, especially if you look at core inflation, is now increased to 5.6% from 5.4%. And what is also interesting is that food prices, it's bread and cereal, which speaks to the drought, and also vegetables, which are sensitive to the drought. And we saw double digits increases there. But another factor that increased inflation is the fuel prices. So on a month-on-month basis, it actually remained quite flat. But on a year-on-year, we started to see base effects coming through, and we saw quite a big increase, and we're going to see an increase due to base effects also in February. So it's not going to be a pretty print, which also then speaks to, you ask yourself, what is the SARB going to do given such increases?
I mean, two things here, because I think Kevin Ling's forecast, was for inflation to be at 8% by the end of the year. So yeah. I wonder what your forecast is. And also, was the SARB right then to increase rates when it did?
I think the SARB was right to increase rates. I think that, the last print, just this one that we received, is an indication that they could actually increase further in their next meeting. And also their estimates are a little bit off now, because they expected core inflation to average about 5.4%. It's now 5.6%. I doubt that core inflation will come down, so they're likely to increase that, and that's really passed through. CPI too, I don't think that the SARB expected inflation to breach in the first month, and they will then alter their CPI forecast accordingly, and which will then lead them to, or put pressure on them to increase rates sooner than expected. Now, the other problem is growth. And they don't want to increase to such an extent that you are starting to undermine growth. And going back to your other question, do I expect it to increase to 8%? Looking at the current trend, I think that it's not impossible.
Not impossible. So given that you've said that, what exactly are you pricing in terms of rate hikes moving forward? We've got the FRA markets already pricing in 25 basis point interest rate increase come March.
Yeah, so I'd expect a 25 basis point increase. I think in the year we could see 100 basis points and another 100 next year, which is quite significant, especially if you consider growth.
Would that be 100% on top of what we've already had, or in total?
In total.
Okay.
In total.
Thabi, then what about retail sales? So, if high inflation is suddenly going to start whacking consumers, are they going to scale back their purchases? Because
Definitely.
This did seem to be quite resilient.
We always look at December retail sales, and end of the year, beginning of the year, are always a little bit off and not a clear indication of what we expect for the rest of the year. So the slight increase that we saw, I don't expect that to be the trend. The trend should be down. It is interesting that you did see, household appliances, general dealers. So bulk buying did increase. But it also does speak to a little bit, because wage inflation is still quite high. Remember that the 3-year wage settlement that we saw in government came into effect in January. So that could support somewhat retail sales. But given the health of the consumer currently, I don't think that is something that is sustainable.
So given what you've said then, what do you see this doing to the debt to disposable income ratio in the country, and how much risk are you starting to feel, more risk are you starting to factor in?
I mean, the NCR, the National Credit Regulator, has been warning that they are seeing more defaults. So even though we've seen wage growth increase, there's still a lot of pressure from that households are getting. Remember that inflation is increasing. Interest rates are now increasing. Food prices are, will impact directly, unlike other prices that are a bit of a lag. So we are seeing food prices change in the stores, and people are complaining, and suddenly they're also changing the type of foods that they're eating in response to food prices. So there is a behavioral change. There's also, if growth is still quite slow, that means that we are unlikely to employ more people. So, unemployment will still be quite high, and I don't expect, the health of the consumer to change because there's a slight increase in wages.
And then tax increases, which we all are bracing for next week. Is that going to be another, I suppose, cyanide pill to swallow?
Definitely. Tax increases. I'm still not, in two minds about the VAT, because I think that is, especially in election year, I think it is
political hot potato, social political hot potato.
But we could see personal income tax increase. We could see corporate tax increase. We could see also another increase that's similar to what we saw in February last year, where the tax brackets go up slightly. And so that will obviously put a lot of pressure on consumers. Another thing is that, where the National Treasury or our minister is very constrained, he needs to find ways in which to not only shrink the spending, but also try to find ways in which to have, increase the revenue. Yeah. I know this will be political and politically sensitive, but we have a lot of people who depend on social grants. And if that dependence is actually shrinked, maybe we could see a narrowing of the budget. But again, how will he do this? Will it be politically sound, especially in an election year, and especially at a time where consumers are so constrained and feeling pressure?
Well, we're certainly going to be needing ingenuity at its best. Let's leave it there. Thabi, thanks so much for having joined us today.
It's a pleasure.
Thabi Leoka is economic strategist at Argon Asset Management.
See a vision of the future with laser-like technology in the all-new BMW 7 Series. The exception rules.